So just in case, I've prepared a brief explanation for book value and market value. First, book value, it refers to the value recorded in the company's books. So specifically, the amount listed on the balance sheet. So all of the figures that we've reviewed so far in Financial Modeling 101 can be considered book value. In contrast, market value, it represents the amount at which the company or its assets are valued in the market. So a common example would be real estate. So book value is typically recorded at historical cost, which means that no matter the actual changes in the prices in the actual market, it's going to stay the same. Of course, we are going to depreciate it in terms of book value. But for example, if the building was purchased maybe 10 years ago for $100 million, and maybe it was depreciated each year at 10 million, its current book value would be around $90 million after a year. But maybe that same building after 1 year can be traded in the market for 150 million. So there's going to be a difference between book value and market value. And one of the parts that this happens frequently is the equity value. So the book value of equity is the amount listed on the books. So we can see Amazon's book value. We can find total stockholders' equity. This number would be the book value of Amazon. But we can see that the market value is, at this point, $878 billion. So there's a huge difference between book value and market value. Generally, which is higher, book value or market value? Well, while it's not always the case, book value is, as I mentioned before, it's recorded at historical cost. So market value is usually larger in most cases. But moving forward, when we're discussing figures from the balance sheet, it's going to be important to clearly specify whether the numbers are in book value or in market value. So I hope these two concepts are now clear, and we're going to proceed to the next lesson.